This is Unit 5, Financial Instruments and Cost of Capital. There are some type of instrument like bond, equity, derivatives. There are some other long-term financing modes, and then if we have existing equity and bonds, this is cost of capital of current. But if today we will issue more equity, more bonds, then this will be cost of capital of new. New always will be higher than the old because of time value of money and all that stuff. This slide is important. I just make it for you before I start the cost of capital questions. When we are calculating cost of equity is cost of debts. There are like cost of capital. So the balance sheet has a portion in which we have bonds, we have equity. Equity is two types, preference and common. And then we have bonds like long-term liabilities. So these are four formulas. First we have to apply to the question to get a percentage. Then the same thing we have to add and get a weighted average cost of capital. Okay. This slide I will refer back when I will solve the question, so you can be very confident. Short-term interest rates are generally lower than the long-term rates. Why? Because in normal situation, what is a normal situation? When everything going smooth, economy is good, people are living happily. If you go to a bank, you want to invest for 3 months, 6 months, 9 months, your interest rate will be lower. And if you want to invest for 3 years, 5 years, 10 years, your interest rate will be higher. This is the normal mechanism. So A is the right answer. He says, what is the term underwriting spread refers to? This is now definition. Spread is the difference between the price of investment banker pays for a new security issue and the price at which the securities are resold. So this is the difference, is his money spread. Okay. If B Corporation bonds are currently yielding 8% in the market, why is the firm cost of debt lower? Look, we should know the tax complication when we have common equity, when we have preference equity, and when we have bonds. Because they have different tax structures. Now, when you have liability like bonds, so these are acceptable as an expense in the tax authority. Okay. So, interest is deductible for tax purposes. That's why when we issue bonds, our cost of capital will be less. When we will issue equity, it will be higher than the bonds. So we can conclude for our knowledge that cost of capital through liabilities or bonds is less than cost of capital issued from equity. This is the basic principle. So D is the right answer. Why? Because interest for bond is allowable according to tax authority, which reduce your cost. Right. Debentures definition. Long-term loans. So debentures are bonds secured by full faith and credit of the issuing firms. Which one of the following characteristics distinguish income bond from the other bond? Generally income bond is related to income.
Yeah.
So when there is an income, you have to pay interest.
Yes.
So income bond pay interest only if the issuing company has earned the interest. So this is the difference between the income bonds and the other bonds. Serial bonds are attractive to the investor. So what is serial bond? There are two types of bond. One is term bonds, one is serial bonds. Term is, look, what is a bond? Bond is an investment for us. We want to invest so we get more money. Now it depends how we want the return. Suppose if I want every month return from my investment, suppose if I give you $1 million, you do a business and give me monthly returns. This is I am asking for a serial return, series of payments.
Yeah.
But if I give you $1 million, I will ask, okay, 2 years after I need 1 million plus my 2-year profit. This is I am talking about term after a period of. So this is what he's saying, that serial bond in which you have series of payments are attractive to the investor because investor can choose the maturity that suits their financial needs. Means you can choose how you get your return, monthly, equally, quarterly, yearly, how you want. The best advantage of a zero coupon bond to the issuer is what? First of all, what is zero coupon, which has no stated interest rate, right? So advantage is interest can be amortized annually on a straight line basis, but is not a non-cash outflow. This is just like an advantage that it is a zero coupon, so you can amortize over the period of time. See, zero coupon bonds do not pay periodic interest. Means they cannot offer you periodic interest.
Right.
The bonds are sold at a discount from the face value. Means if it is $1, it is sold like 80 cents. And the investor do not receive interest until the bonds mature. So whatever you have to pay, you start amortizing. You don't need to pay actually till it is not mature. The issuer does not have to make annual cash outflow for interest because he has to just accrue. He has to just accrue his payment at the time of maturity. Junk bonds. These are again, junk is more riskier because this is a junk bond. So securities rated at less than investment grade because investment grades are more secured.
Okay.
So any junk bonds are inferior bonds, these are more risky. This is the definition. Which of the following statement is true when comparing bond financing alternatives? Means when you are not issuing bonds, you have alternative, either you borrow from bank, you borrow from selling your equity. So if you see, a call provision is generally considered detrimental to the investors. First of all, we should know what are the provisions. One is call and other is put. Call option is when I want to call something from the market. Market is $100. I am buying $110 because I give call option above. Otherwise, you will sell in market, right? So call option is a dangerous thing for the investor, especially when you are considering the other options than bonds.
Right.
From an investor point of view, the least risky type of bond